From Barangaroo Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB. I'm Juliette Sarli this Tuesday afternoon on a record day for the ASX 200. Let's have a look at where the CBA 200 is, up 0.9% there, 1585. And I just want to get your read on where the ASX 200 is as well. 83.21 is where we sit on the close, a new 100-day high, of course, a record. And I think at one point we got even higher than that at 83.31 around 1 o'clock, but still not bad, just 10 points off that on the close. Still will be a record close for us. So let's have a look at the themes of the day, and of course a record reset as we continue to hit these records and following on from more records hit on Wall Street overnight. I think Nvidia once again just blowing it out in terms of those tech stocks moving along, and we had a positive session here as well, really driven by the likes of CBA hitting close to fresh records, pushing the banks up as well, and a lot of momentum coming through in the miners. Bit of a dip coming through in oil. We did have OPEC, of course, slashing its forecasts for oil due to the China story, but also on the oil front, it does look, and this is obviously good news, like we will not see Israel attack those Iranian oil facilities. So that is sending crude lower as well. I just want to make sure that I am getting it right here. Israel may avoid targeting Iran's crude infrastructure, according to Israeli Prime Minister Benjamin Netanyahu telling the Biden administration he's willing to strike military rather than oil. So we've seen West Texas Intermediate slide below $72 a barrel. And I've got bottom of the class there as well, because the worst performer on the ASX 200 today was the country's largest listed provider of international education services, so IDP Education, down about 5%. A disappointing forecast holding at its AGM, warning that it expects international education student volumes to decline by about 20 to 25% in the next year, because of course, as we see these caps, these migration caps coming through from the government. All right, let's get back to the crude story and have a look at how energy players fared today in the session. They were a weak spot. Woodside Energy down 2.7%, Santos Beach Energy under pressure as well. But as I mentioned, we did see some positivity coming through elsewhere. Let's kick it off with where we saw the miners today. Fortescue back above that $20 a share mark, up by around 2%. South 32 though, and Min coming under a bit of pressure. There was a broker downgrade, I believe, on Mineral Resources today. Let's have a look at the banks as well. I mentioned CBA there powering along, up 2%. Look at that, just under $140 today. ANZ up 1.4%. NAB is up 1.5%. And just having a look at some of the other stories we followed today. Hub 24 booking record quarterly net inflows. It also is confident in meeting its funds under administration target for 2025, shares up 2.5%. Now heading the other way, Tyro payments plunging. Now this is on a potential ban by the federal government, really trying to tighten these regulations on debit card surcharges. So Tyro at one point I think was down something like 16%. We mentioned IDP Education falling, the worst performer on the ASX 200. Baby Bunting came through with an update at its AGM. It says it's on track to meet its full year 25 guidance. That, it says, though, is pending no downturn in the economic or retail environment. And Ampol had a $50 million cost reduction. It posted a 42% drop in third quarter Lytton refinery output, really focusing on turning around that refinery. Shares hitting a 1.5-year low. Let's get into all the day's action. Martin Crabb from Shaw & Partners joining me. I did a hit with Channel 10 today and they said another day, another record, but it kind of feels like that, even though we should be very much celebrating here.
Yeah, it's melt up though. Like it's not like we've been down in the doldrums for ages, and all of a sudden we stuck our head up and created a new record. It's just been this grinding high narrative, isn't it, Juliette? Where we come in the morning, there's no real news, and the market just grinds higher, and it's this kind of any lingering concerns about hard landing, which roiled the markets back at the start of September, if you remember that. That sort of sell-off we had on the US employment data, that seems like a distant memory now. And it's just like every day you come in and there's no bad news, and the data that is coming out, whether that's survey data, consumer sentiment, business sentiment's improving, credit card spending's improving, it all seems to be okay. So the market just wants to go one way, doesn't it?
It does. Well, one stock in particular I know caught your eye as well, Hub. I mean, this is a very strong growth story. What are you seeing here?
Yeah, well, the platform market in Australia is still dominated by the banks and the insurance companies that own these big platforms, whether it's, BT, Panorama or Macquarie Wrap or whatever. But, the banks are sort of getting out of wealth management by and large. And in fact, probably Westpac would be a seller of their platform if they could find a buyer. But then you've got these newer players like Netwealth, Hub and Praemium who have better platforms. I mean, the net promoter scores, which some firms do on the platforms, show that Hub is the most liked platform amongst financial advisors, but it's only got a 7% market share. So it's got a long runway. I mean, do we need 20 platforms or 15 platforms in Australia? It's probably like super funds. We probably need 5 or 6 really big super funds. We probably get 2 or 3 really big platforms, and that'll be a stable market. And so I think that Netwealth and Hub, and to a lesser extent Praemium, just keep eating the lunch of the majors. And we saw that with the fund flow, almost 4 billion. Their targets to grow at another 10 billion or so in the next 12 months. Based on today's numbers, they'll easily do that if they can continue to grow market share. So it's on a bit of a nosebleed PE. It's on something like 70 times earnings, but the incremental dollar that comes in, Juliet, they make pretty good margins on it. It's mostly a fixed cost business, or largely a fixed cost business. And so the operating leverage is really strong as well. Now, can they keep their margins? I don't know if they can. There might be some margin erosion, but it's just one of those things you go, I'm just going to put it in the bottom drawer, and next year it's going to have more FUM and more revenue and more profit, and that's just going to keep going for years.
Heading the other way, I should say, though, in that sort of, I guess, financial space is Tyro. This potential ban from the government, great news for us as consumers. Yeah. What is it going to do for the likes of Tyro payments?
Yeah, I mean, I save 5 cents a coffee every day, right? Yeah. So those merchant fees, which, I think 10 years ago, you could probably argue that it made sense to charge a merchant fee because, you've got the rails, you've got the cards, you've got all that sort of infrastructure they need to pay for.
You even had the piece of paper and everything, which you don't have.
But now none of that's the case. Yeah. So it's just kind of being charged for nothing. So payments firms, so it's something like 60% of payments go through 60% of transactions are through payments system. So that's not going to go to zero overnight. It'll be repriced somewhere throughout the deck. So I think the market's probably shot first, asked questions later, but there's definitely erosion there. So the question is, will the full saving be passed on to the consumer? Will the merchant wear some of the pain? Will the payments platforms and providers wear some of the pain? And I think most people are just extrapolating that the payments platforms like SmartPay, there's another operator that was off a bit today, and Tyro, that they'll get knocked around. But there are some other players in the market. It's probably Visa, MasterCard. It's probably the big global guys. And Australia is such a tiny part of their business, so they're not even going to notice it. So yeah, it looks like it's a good win for the punters, and the government obviously acting in just trying to deal with the whole cost of living exercise. So what else can they get rid of?
I mean, to me, it's just catching up with other fintech players too. I mean, as you know, I lived in Singapore for a long time. There is no surcharges there. And even if you pay somebody cash, if I'm paying you, I just transfer from my phone to your phone, and that's considered cash. Here you do that in Australia, you get hit with a 10% GST impact. Yeah,
it's crazy, right? And it's interesting, you go around the world and like the US peer-to-peer lending's massive, right? So if you look at someone like Block, who owns, who bought Afterpay here and is listed on the ASX here, they've got this cash app. So a lot of people use a cash app rather than a bank account to transfer money. You go to Japan, it's still cash. Yep. Like there's a lot of places they go, no, you can't use payments to go. This is one of the most technologically advanced countries in the world, and yet they still use cash. So it's really interesting. Different economies and different markets have different approaches to how they pay for things. But obviously Australia is probably one of the better ones in terms of cash transactions, or i.e. we don't have a lot of cash. Well, I can't remember the last time I took money out of an ATM. I don't even have a card anymore. Everything's on the phone. So I think Australia's kind of well advanced, but it's still quite expensive, as you said, to even buy a cup of coffee. It's an extra 6 or 7 cents every day, times the number of coffees, times 28 million people. Yeah, that's a big number.
Yeah, true. All right, let's get to some of the leading indicators that we're seeing as well. So you're saying this is just getting back to our earlier point, a lot of positive development here for risk assets.
Yeah, so one of the asset allocation signals we look at Shaw and Partners is the composite leading indicator. So it's basically a measure that's designed to give you a read on where the economy and therefore profits are going to go 6 to 9 months in advance. Now, the OECD in Geneva have been publishing these composite leading indicators back all the way back to the 1950s. So they're great for looking at markets and markets history. But they came out on the weekend with a revised set of data and also updating for September. And you can see there just graphically, without going through what each one of those squiggly lines are, is that everything's trending up. The only one that's hard to see there is Japan. Japan's probably softening a bit, but that's just one of the reasons the equity market's melting up is that all these composite leading indicators are pretty much pointing north. Even China, which had been slowing, the stimulus packages that have been announced there suggest that economy might pick up its rate of growth as well. So this is just leading to a melt up in earnings expectations and a melt up in share prices. And if we combine that with financial conditions, which is the other measure we really look at, is money is just becoming cheaper. So we're starting to see, obviously, cash rates come down around the world. We're starting to see corporate borrowing spreads continuing to narrow. We look at something like the hybrid market in Australia. Spreads have come from 3% into less than 2% there. So that's financial conditions easing. It's getting easier to get a loan. It's getting cheaper to get a loan. So you combine that with higher growth expectations, they're both very positive for risk assets, and one of the reasons the market continues to go up, even though it's expensive.
What does it all mean for when we may see a cut from the RBA?
Yeah, I think the data is coming in better than feared, and we're starting at 4.35, not 5.5 like the Fed. So I still think, and there's still a lot of stimulus in the system. So we've seen the first round of tax cuts come through, and people haven't spent that, but doesn't mean they won't spend it. So will it take a couple of paychecks for people to realise, I'm getting a bit more money each week, and therefore I can start spending a little bit more. So I think the card data that we track, and most of the major banks now provide their card tracking data, so people can go onto their websites and have a look at it, suggests that the Australian economy is still pretty robust. People are still travelling, people are still spending money. So I think that's going to keep inflationary pressure in the front of the mind of the RBA. They're not worried about the employment market. The employment market's not weakening here the way it is in the US. So I think in terms of their dual mandate, they've still got more of an inflation forecast than an unemployment one. That might change in the new year, or if we get some really weak labour data. I think labour data's out on Thursday this week.
Yeah.
So if we get a really, really bad jobs number, you probably need 2 or 3 of them, but that would be the only thing that would change the narrative. If I'm in the RBA, it just makes sense to be on hold.
Yeah.
We're saying February next year, Juliet, before they go.
And I heard, I was talking to Paul Bloxham from HSBC, he was saying, look, they could hold for a really, really long time, could even get to the point when the Fed is done with their cutting cycle and we haven't started. But anyway, that is a question and a topic for another day. Martin, thank you as always. Martin Crabb from Shaw and Partners. Let's get to the stock of the day today, and it was actually an international special, and we had 2 stocks of the day. We had Alibaba and also Amazon. Let's have a listen to Ted Alexander from BML Funds and Lachlan Hughes from Swell Asset Investments.
If I was a global investor, I'd always look to have a exposure to this because at some point it's going to absolutely ramp, and I think your stock doubles.
All right, but not yet? Or
Well, not until
you're waiting for further stimulus and
fiscal,
then you buy.
we need some fiscal. This is rubbish. There's a little bit of monetary stimulus.
Yeah,
that's
but
all.
hang on. So just in terms of timing though, would you be buying Alibaba right now on the premise that we are going to get some decent stimulus out of China?
Yeah, I think any point here, you're buying at half price. So any point here, you're still good. Now, you're trying to second guess what's going to happen in the next week in a volatile market like China is going to be really difficult. But if I'm buying for the long run, I know that if I buy Alibaba today and we get fiscal stimulus and we get the market rally, I'm going to make a really strong profit. So for that reason, I'll be buying it for exposure to that factor.
But Amazon's in a very strong position with its infrastructure. It's one of the strongest moats in the world. Very hard to run down Amazon from where they are today. So we're bullish on Amazon. Yes, it comes with a high multiple, but we believe it comes with materially less risk. And it's a business that's going to earn $100 billion in free cash flow in 2026. So it's producing a hell of a lot of cash. Gets very good returns on invested capital. They're continuing to make smart investments, whether it's the satellites they're launching at the moment, which will provide potentially internet services for their prime customers. So look, they're in a very strong position.
All right, well, let's get back to our market now and have a look at the market leaders on a record day for the ASX 200. Helios among the front runners there, up 7.5%. Johns Lyng, of course, focusing on the rebuilding efforts in Florida after Hurricane Milton, up by 5%. One of my favourite jewellery stores, Lovisa, up 4.3%. Regis Resources in the gold space higher as well, along with Ordinate up 3.5%. Let's have a look at what we saw in terms of the laggards. Now, we talked about IDP Education being the worst performer on the ASX 200, warning that it expects international education student volumes to decline by 20 to 25% in the next year due to the migration caps. Treasury Wine Estate coming under pressure as well. Sandfire Resources, TPG Telecom and Harvey Norman, which was trading ex-dividend. In the small end of town today, Orthocell had a good day, up 12.5%. Wildcat also there to the downside in the small end of town. SmartPay, of course, just continuing on that thematic that we saw with Tyro Payments, which was down 12%, and a couple of energy players as well. All right, coming up tonight, we get a lot of the banks in the US. So Bank of America, Charles Schwab, Citi, Goldman Sachs are reporting. Also J&J, United Airlines, United Health and Walgreens. We've also got the Empire State Factory Index being released. Canada comes through with its CPI and France comes through with its final CPI month on month as well. Tomorrow, Q3 inflation read out of New Zealand. We know that the RBNZ just cut by a jumbo 50 basis points. Japan has some machine orders data due. And then locally, we've got BOQ, Challenger, Evolution and Rio with quarterly reports. So Rio, of course, will be in London tonight. AGMs as well from Origin, Bapcor, CommBank, Clinuvel, Aurora, Redox and the Reject Shop. It is certainly AGM season, isn't it? But let's just have another look at where we are on the market. A record high, as I mentioned, on the ASX 200. It has closed at, drum roll please while I find it, it has closed at 8,321, up 0.8%. So that's a record close for the ASX 200, and intraday it hit a new high as well of 83.31. And in fact, I think I may have misspoke, because the previous high we've reached was 82. No, we've surpassed that record there. So 83.31 is where we saw a high today on the market, closing at 83.21. It is hard to keep up with all these numbers, but we will take another record, as Martin said, just continuing to inch higher on not much news, but obviously fundamental belief that this market can manage these highs. We'll see you again from 9:45 a.m. Eastern tomorrow.